I do agree that Greece is a more acute risk, and I'd probably put Ukraine next. But I do think that investors have neglected and become complacent about the risk in China, in particular the risk of real estate debt. And you might think of developers here, you might think of local governments that are trying to push forward projects just to keep the momentum going when there's no real demand-driven story behind that at the moment. So I think there is some risk in China for a financial disruption, particularly from the developers. You could also throw into there some of the large materials corporations and of course the local governments and the developers. But yeah, that's a risk that's underappreciated. I would still put the probability at less than 50%, but it's worth keeping on the radar.
Underappreciated, the risk. Where are you seeing that transpire? Are you talking about the share prices of those developers? Because if you take a look at where they're trading, Paul, I mean, they're trading at 50% of book value.
Right. Well, the broader risk in China is that because the market has gone up so much, that there are probably some risks below the surface that aren't being appreciated yet. As I mentioned, some of the developers fall into that category. I put industrials and material companies in there, and it's, again, difficult to appreciate or reckon the risk at the local government level since, of course, they don't trade in the markets.
And Paul, you know, the Chinese authorities have now embarked on a number of efforts, of course, to ease policy, to cushion the falls that we're seeing in the world's #2 economy. Do you think that they have enough tools within their kitty to sort of prevent any drastic slowdown in growth there?
I think they believe that they do, and I think that they have shown an ability to be proactive, and both of those are positives. But one can never really predict what sort of first domino to fall may create further falls and further spread. A sequence of unexpected financial failures, for example, anywhere could create more problems than any government is prepared to deal with in the moment. I do think that China would eventually recover from that, but it could be a tense period, short-term period for Chinese equities and for investors around the world.
Okay, so if Chinese equities are not really pricing in the risks that they may be facing in terms of the world's #2 economy, what's the best strategy forward to playing Asian stocks? Which markets do you like best?
Well, we do like Korea at this point, and we generally like those markets that we think have the best external positions and the best prospects for maintaining currency. So as long as the yen does not depreciate greatly, and we do not expect it to, we would continue to like Korea and Taiwan at this point.
And which are the markets that you would be avoiding in the Asia-Pac region, as of course we are waiting upon the Fed? We think, we hope, maybe we're not hoping they're going to increase interest rates. But as we see the transition in monetary policy to one of normalization, surely there are going to be some markets out in this way that you know, people are going to want to avoid.
That's right. I think as the Fed gets ready to meet next month, we could see a removal of the patient language that could create some volatility in markets as people bring forward their expectations of the first rate hike. And for that reason, we would hold off on Southeast Asia for now. But otherwise, we would like the prospects, the economic prospects in the Philippines. We would just hold off on that until we get that first bout of Fed volatility. But the one we would really avoid at this point would be Australia, because we do think the currency has much further to fall.